Al, let's talk about the professionally managed equity and bond portfolios. Uh, this money manager is PTS Money Management. Uh, they're a tactical investment company, meaning that they want to do the same thing as with Clark Capital, where they want to participate when the market's going up and go to safe haven when the market's going down. They're an asset company. They're a registered investment advisor. They have over 70 years experience between their management staff, and they do a very good job, as you'll see when we go through the presentation. The keys to investing, successful investing, is first of all, capital preservation. So if you don't lose it, you don't have to make it up. In this case, this just shows 3 years of investing, making 15% a year, 3 years in a row, and the third year losing 35%. So if you went up 15, 15, and 15, you went up 45%, and you lost 35%, offhand you think you're ahead. But actually what happened here is the account went from 100,000 way up, lost to 35%, and then after that it went back to a loss and all the gains wiped out. That's for the capital preservation. Then we also look at consistency. Here we have two portfolios, A and B. Portfolio A made 20% the first year and the second year. The third year it lost 20%, and the fourth year it made 20%. So that's 60% gain, 20% loss is a 40% gain. Investment B, more consistent, 10% gain for 4 years in a row. They both made 40%. So which one made the most money? Well, if we look at investment A, that returned $138,000, $38,000 gain. Investment B, $146,000. That's a 21% difference in the amount of money you made in your portfolio over those 4 years and being more consistent. So consistency is one of the keys. That's the first part of it, is capital preservation and consistency. So we'll look at the step 2 of the investment process. If you look at these different areas here, you'll see that this divides its money up between bonds, international stocks, and domestic stocks. In doing so, this goes back and says in 2008, they took a very defensive position. The position being they felt the market was going down. Maybe it had time to be in some cash, sometimes it would be in money market, sometimes it would be in bonds. In this point, of their different portfolios they have 3 different portfolios, conservative, moderate, and growth. Their average weighting was 91% in cash during 2008 when the market was getting beat up. Step 2 is proactive process. When you have a market going down, at some point it's going to turn around and go back up. In this case, this shows in 2009, when the market had bottomed out and turned around, they started going back into the market, not all at one time, but gradually going back into it to get back invested in the market. One of the biggest problems I find that people have is when the market goes down, they hang in there, and then at the bottom they get fearful and they sell. And whenever they do get back in, they wait, and then when the market's way back up again. What I have found is bad things happen when the market's high, and good things happen when the market's low. So when is the best time to buy? The old saying is buy low and sell high. Who actually does that? Most people sell when it's low because they're fearful, and they buy because when it's higher because they feel, oh, I got to get back in because I'm going to miss it completely. So good things happen when the market's down. Bad things happen when the market's up. Here's an actual chart looking at their growth portfolio. If we look at this, in November of 2007, you'll see they're about, just about 50% cash, maybe 40% and 30% in domestic and 30% in international stocks. And then as the market started to go down, which it did, the high was in 2007, they went to about 75% cash and 25% international. The next move they make, and you can see the dates right here, they went to 100% cash, and then they made another change here. Went to partially cash, partially stocks, partially bonds. That was in November 2008, and it looked like maybe they made a mistake, and then a couple weeks later they went back to keeping the bond positions and raised more cash. The market continued going down, but the bonds started to settle out a little bit, and they had about a 50-50 mix. Then going into January, they added a little bit more stocks. Mm-hmm. And then in May of 2009, they added more position. So what they're doing is they're saying, yes, we want to manage our allocations, when we're going to be in stocks, when we're going to be in bonds, and they don't do it in the type of thing where they're jumping around a lot, but they do what the market will give them. What the market dictates. The market's going down, it's a hard place to make money. Market's going up, it's time to be invested. Here's the crust of this portfolio, which I really like. If we look at the different investors for different portfolios, we have a conservative, moderate, and growth. If we look at this chart here, this gives you an outline of their portfolios or their criteria, their limitations, what the portfolios have. So if you look at the conservative portfolio, it says that at any time they can be invested up to 40% in domestic stocks. They can be as high as 40% in global stocks, and they can be as high as 70% in bonds. But if you notice the blue line down at the bottom, they can be 100% cash. Mm-hmm. So when the market's getting beat up, they'll put more money in the bonds, more money in cash. When the market's going up, they'll put more money in stocks and bonds. But being conservative, they'll be more balanced. Moderate, same criteria, except the limitations. They go up to 60% in stocks, both domestic and global. That's up to 80% in bonds. In growth, they can go up to 100% in stocks, 100% in bonds, 100% in whether it's global or it's domestic stocks, or 100% cash. So they have a little bit more leeway. That's the reason why in 2008 they did so well compared to the stock market.
So they have people on staff that sense this and they study these trends?
Well, what they're looking at is they're looking at the indicators in the market. There are always indicators in the market, it's just how you interpret them. Apparently they do a pretty good job of interpreting them, and yes, their job is to protect the money when the market's going down. That doesn't mean you're not going to have a loss. It just means you keep the losses to a minimum. Mm-hmm. And to be invested in the market when the market's going up. Now, this isn't like you pulled up to the traffic light and you have red light stop and yellow light caution and green light, you can go. But it's something similar to that. And they pay attention to it, and they do a good job, which you'll see in a moment. It's very simple to implement the program. We can, they also, if you have a 401k or you have a variable annuity or a variable life insurance contract, they will also manage that for you if you want. Most of my business is people with IRAs, 401ks. They roll into IRAs, give them more options and more latitude what can be done with the assets. This chart here shows PTS Management. It shows their account, and this versus the S&P 500. The blue is the S&P 500, and the red is this account. And if we look at this, they look for long-term success and risk management. And the way to do that is to keep the losses to a minimal and keep the gains in line, being competitive. If we look at this chart, the blue is the S&P 500. You can see how volatile that was. And this is their portfolio in the red. And we can see at the beginning of the chart, the market went up and they went up. The market went down, they went down. The fact is they didn't go down as much as the market went down. Mm-hmm. Then when they started back up, they started from a higher point and they went up, and the market went up, and they actually ended up pretty much breaking even there at one point. And then in 2007, the market really got hit, and they didn't. But look at the difference in the amount of money $100,000 started with in the portfolio. Wow. Now, if you were taking money out of that account, I can tell you this much, the difference would have been even bigger. So this is assuming you never took any money out of it. So when you're taking money out, having consistency and keeping the losses to a minimal is of the utmost importance. The next three charts we have here are on their three different programs. One is the conservative portfolio, and it gives you the years they had and the returns that they had. What I find is a lot of people key in on the years 2000 to 2002 and 2007 to 2009 because that's when there was a lot of volatility in the market. And if you compare this to the S&P 500 or other accounts, I think you'll be happy with the results that you have here. So this chart's on the conservative portfolio. The next chart is on the moderate portfolio. And you'll see the same thing. It did a little bit better than conservative, and 2008 it lost a little bit more, but the other years it made a bit more. And the third chart is the growth portfolio. What I like to key in on here, if we look at 2008, and this is something you compare directly with the S&P 500, is the benchmark that it uses. This account lost some money. It lost 13%. The stock market, the S&P 500, lost about 37%. Mm-hmm. So which would you rather have? But more importantly, if you look at 2009, the stock market bounced back. The S&P 500 bounced back somewhat, and they made about 26%, where this one here made well over 30%. Wow. So it did better in the good times and did better in the bad times. So consistency is important. And the last chart is just a composite of using all three portfolios and what the returns were with all three portfolios. Some people will take a look and they'll take a look at something like this and they'll put a certain amount in conservative investments because they want to draw money out of it and put an amount in growth because they want to get more growth to give them a little bit of edge with the market. So it depends on what your alternatives are, or what your objectives are, your goals are on how the money gets divided up. Again, there's a little plug for PTS, and they talk about having 20 years successful record, and certainly I think if you look at these slides and the proof of it, that you'll probably agree with that. Where do we go from here? You can download, if you're on my internet viewing this video, you can download the equity and the bond portfolio review. You can, a number of these charts, and they may be updated by the time you get them. They'll be there for you to take for your review. You can contact me for additional information. My name is Paul Fair. Paul Fair Associates is a registered investment advisory firm working with retirement solutions for people. So my website's paulfair.com. Take a look at the website, and I hope to hear from you soon. Thank you.